Welcome to this week's market drama. We'll begin with the S&P 500, which was up close to 6% for the week. It is now up 13.5% year to date. NASDAQ was up even more, up 6.6% for the week. Treasury yields fell, especially the long term of the yield curve. If you look at a 10-year Treasury bond, it went from 4.88 to 4.48, its lowest level since last September. So what's driving both that bond market action as well as the equity markets? Two main factors this week. One was the Fed had its meeting, and as expected, they didn't change interest rates, but it did strike a more balanced tone around the outlook for upcoming rate decisions. They basically said that the decision of raising and lowering interest rates is more balanced, right? So from that perspective, it gave the equity markets enough to be excited about, right? That the Fed might be done, and it also helped the Treasury bonds when you looked at the employment report that came out this past week, which showed that in October we saw 150,000 new jobs. That was below expectations. We also saw average hourly earnings rise 0.2% month over month. That was below expectations. And that gives the Treasury market some pause of rising yields that we've seen the last couple months. Why? Because it does show that maybe, just maybe, inflation will continue its trajectory lower, especially when wage growth continues to decelerate its growth, and the employment picture is not as strong as it was before. It was basically like it gave us the sweet spot of data, which is, hey, not recession-like numbers for employment. If anything, we're seeing job creation here, but not as strong job creation as we were seeing in prior months, which was inflationary. So that's it for this week. Stay tuned for next week.